In the Strait of Hormuz, massive crude oil tankers are halting their forward momentum, paralyzed by maritime closures. The current market volatility is a leverage unwind trade, operating under the disguise of an energy crisis. The physical catalyst is clear. The closure of the strait has removed roughly 20 million barrels per day of global oil supply from the market. But the actual threat lies in the structural fragility beneath the prime brokerages. Prime brokerage data shows gross hedge fund leverage has hit an all-time record of 292.8%. Federal Reserve data reveals 73.8% of hedge fund repo borrowing happens at a zero haircut, meaning borrowed cash equals the pledged collateral. Therefore, institutional cash buffers are effectively an illusion. This cash is already pre-pledged to maintain the massive leverage ratio. Market volatility is currently pricing an imminent structural funding break inside prime brokerages. Standard macro analysis assumes a linear sequence. Oil prices rise, inflation follows, and central banks push equities down. That model is directionally accurate, but structurally incomplete. This dual-axis chart tracks the market's dominant intraday regime signal, a near-perfect inverse correlation between Brent crude pricing and the S&P 500. The mechanism moves in lockstep. Recently, a 5.3% drop in Brent crude immediately triggered a 1.0% climb in the S&P 500. The equity recovery trade relies entirely on the normalization of physical oil supply. It operates independent of geopolitical ceasefires or political posturing in Washington. Portfolio managers attempting to trade the military headlines are looking at the wrong data feed. The only actionable metric is whether Brent crude breaks its definitive technical support lines. The physical disruption of oil forces global central banks into a corner through three distinct channels. Channel 1 is the immediate, visible shock, Brent crude surging 40% to hit $107 a barrel. Channel 2 is the delayed transmission to headline CPI. Institutional forecasting models are currently fracturing over how this translates globally, with stark divergences between European and Asian inflation estimates. The European Central Bank's severe scenario modeling projects Eurozone inflation reaching 4.4%, while total GDP growth drops to 0.9%. Systemic rate sensitivity to oil supply news has increased by a factor of 3 since 2022. This physical supply shock translates into a mathematical inflation trap, applying immense, unyielding pressure on central banks to hold rates high. They cannot ignore the data, and they cannot ease policy without accelerating the crisis. The most dangerous transmission mechanism is Channel 3. The bond market is moving aggressively, and doing so without policy input from the Federal Reserve. This yield curve shows the Fed funds rate anchored flat at 3.5%. Meanwhile, the 30-year yield pulls up to 4.8%. This reprices the term premium, the extra yield demanded for long-duration debt amid inflation uncertainty. The market extracts an extra half point strictly for war inflation. This unmanaged steepening of the yield curve acts as a binding VaR constraint inside prime brokerages. When volatility spikes, these internal risk limits trigger algorithmic deleveraging across the board. We have already seen the first observable symptom of this break. In early March, Goldman Sachs recorded a multi-strat Mageddon, a 4 standard deviation momentum drawdown across multi-strategy funds. The bond market has broken the standard duration playbook, rendering traditional risk parity models ineffective. All of these forces, the oil shock, the leverage vulnerability, and the bond market repricing, intersect at the April 28-29 FOMC meeting. The institution is facing political paralysis. April is Jerome Powell's last scheduled meeting as chairman, while his presumed successor's confirmation remains blocked in the Senate. Markets are attempting to price in the Warsh doctrine, a preference for medium-term frameworks over immediate data dependence. This succession uncertainty removes reliable forward guidance. The current Fed consensus is operating on a razor-thin margin. The March baseline median projected just one single rate cut for all of 2026. This dot plot grid illustrates a catastrophic binary risk. If a single Fed participant shifts their projection to hold through 2026, the entire median crashes to 0 cuts. That single shift triggers an immediate repricing of the yield curve's front end. The Fed is boxed into a policy trap. Cutting rates exacerbates the term premium, while holding rates detonates the over-leveraged hedge fund parity trades. An unresolved oil shock meeting a zero-cut Fed policy leads to extreme institutional redemption pressure. Forced liquidations fail because funding structures break before prime brokers can even place the sell orders. This circular flowchart maps the Office of Financial Research's model of a repo cascade. Margin requirements rise, forcing the fund to sell bonds. That selling widens the basis, and that basis move instantly increases margin requirements again, feeding the loop. Inside this loop, internal VAR limits act as binding constraints. They force algorithmic unwinds even when raw repo financing appears available from the banks. Recall the zero haircut data. Because the fund's cash is already pre-pledged as collateral, the fund possesses zero actual defense against the first margin call. Surviving a redemption wave is a collateral sequencing problem. Survival requires converting overnight repo to 90-day term financing before the stress event materializes. Once the cascade starts, term financing is repriced or unavailable. Tiers 1 and 2 of the liquidation protocol require securing unencumbered cash above 8% of NAV and executing liquid positions strictly via dark pool VWAP. VWAP, or volume-weighted average price, is an execution strategy that spreads orders proportionally to market volume to hide institutional footprints. Tier 3 logic transitions to implementation shortfall algorithms. This algorithmic framework dynamically front-loads execution to minimize the price difference between a trade decision and its final fill, preventing information leakage to high-frequency traders. For Tier 4 in liquid assets, do not liquidate Level 3 assets into a stressed market. Instead, activate fund gates to protect the remaining NAV. The medium-term thesis remains intact. 75 years of market analysis proves an 8.4% average S&P gain in the 12 months following external geopolitical shocks. Ignoring the war headlines and securing collateral architecture now allows for a recovery trade entry once Brent crude breaks sustainably below $90.